crypto is now sort of pivoting towards being accepted by governance, by regulators. There's big institutions, BlackRock, Janus Henderson, a whole laundry list of them that are excited to start getting on chain. Um, so I think the confluence of all those factors, like the infrastructure is ready and the users are now kind of coming here in scale, is um, it's a really exciting time for DeFi.
Hey everyone, quick shout out to today's sponsor, Namada. Namada is currently entering phase 3 of their mainnet rollout, so make sure you check it out by following the link in today's show notes. We'll talk more about Namada later today, but for now, let's get started. Quick shout out to Permissionless 4 coming this summer to New York, June 24th through June 26th. We'll have speakers from all across the industry, including Hayden Adams, Kyle Samani, Guy Young, and more. Get your tickets today by following the link in today's show notes, and make sure to use code BELL10 to save 10% on your purchase. See you there. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another episode of Bell Curve. This is a special episode because we are bringing back seasons here at Bell Curve, which I'm very excited about. And this is the episode where we're kicking off the season, and I'm introducing my co-host, who I'm very excited to be doing this with, Mr. Monet Supply. Monet, welcome, man.
Yeah, thank you for having me on. Excited.
There should be an excellent season. Very excellent. I think at some point we should maybe wear those sauna caps if an episode ever calls for it.
Whenever it's getting too hot and spicy with the guests, that might be a time for the sauna hat.
We'll bring the sauna caps on. So guys, I'm just going to give for those of you who haven't followed, this is actually the 9th Bell Curve season, and we're going to be focused all about DeFi this season. But for folks who haven't gone back and listened, just a quick recap of the format. So this is going to be a 9-episode arc. So this is the kickoff episode where Monet and I are going to be detailing what are the big themes and ideas that we want to be digging into this season. So this episode will give you as a listener kind of an idea of what you can expect over the course of this season. So there's going to be a kickoff episode, 7 interview-based episodes, and then we're going to do a wrap-up at the end of the season for just lessons learned and takeaways and stuff that came up throughout the course of the season. But that's a rough idea of the format. Each interview is going to be, Monet and I will kick it off. We're going to do an interview with 1 or 2 guests, and then we'll do a 20-minute recap of each episode as well. So without any further ado, I want to introduce the first theme of this season of DeFi. Well, actually, maybe just even before we get into that, Monet, I'm curious, you've been in DeFi in the weeds for a very long time, probably on more forums than you would like to admit, but getting in the weeds with a lot of DAOs. And I'm curious, this feels like a really interesting moment in time for DeFi and a little bit of an inflection point. So the kind of narrative out there is the institutions are finally coming. But I'm curious, what is it about this moment in time that makes DeFi very exciting for you, or what gets you kind of out of bed in the morning?
Yeah, no, I think it is a really exciting time for DeFi. A few different kind of reasons that are driving this. I think for one, as a space, we've been investing in infrastructure for years and years. Maybe even you could say over-investing and not enough sort of focus on apps, but it feels like the infrastructure, chains, L2s, bridges, oracles, it's reaching a point of maturity where we actually have enough block space. We have enough scale to start doing useful things. So that's exciting. I think even a couple years ago when L2s had just launched, it was still kind of very much training wheels phase. And now we have all this infrastructure, and it's really up to app builders like people in DeFi to start using it, putting it to good use. I also think that, kind of the DeFi technology, we've gone through a lot of sort of testing phases, DeFi summer 2021. We were just kind of throwing stuff at the wall and seeing what stuck, but we've gone through some pretty brutal bear markets. The stuff that has survived has kind of proven that it's Lindy. Sort of the primitives that we're working on make sense. So yeah, I think we have a lot of proven sort of building blocks to work with. And then, like you said, the institutions, they are actually here. Crypto is now sort of pivoting towards being accepted by governance, by regulators. There's big institutions, BlackRock, Janus Henderson, a whole laundry list of them that are excited to start getting on chain. Um, so I think the confluence of all those factors, like the infrastructure is ready and the users are now kind of coming here in scale, is um, it's a really exciting time for DeFi.
I completely agree. I would also add to that as well. I think some long-standing debates in DeFi are potentially on the cusp of starting to get answered. And what this makes me think of is, back in kind of the 2019 or 2020 timeframe, Maker kind of had this big decision to make Maker, now Sky, of do we go down the path of real-world assets or do we not? And the challenge back then was, hey, we basically exist as a way for people to get some amount of leverage on their Ethereum, that or on their ETH. There's only so large that market can really grow, and we need to keep this DAI relatively stable. So how do we do that? And there's this kind of big fork in the road of, do we go down the RWA path or do we not? And we're starting to finally get answers to some of those long-standing design decisions. And yeah, I think that one of the big questions that at least I have going into this season is, now that institutions are actually here, and these aren't just proof of concepts that are being run out of Bank of America's innovation budget that they kind of stick the 25-year-old blockchain guy who just really loves it in. It's how are the introductions of these institutions actually going to change the space? And overall, the design of protocols is definitely something that I'm really interested in. And maybe with that, we can introduce the first theme of the season, which is fragmentation and then reaggregation in general. And I'll kind of, level set in terms of what we mean by that. And I would love then for you to dig into it. But, I think that when you're looking at the current iteration of protocols in DeFi, be that DEXs or borrow lend protocols or what have you, there's kind of this very common design choice and philosophy around, maybe you'd even call it like a modular design. But this could be anything from Lido v3, which is kind of bring your own validator and a vault architecture, to Morpho's vault architecture, to even something like Uni v4, right, where you have a bunch of different AMM hooks that there's a front end and kind of a settlement layer underneath. But the idea is, instead of these kind of monolithic, immutable protocols, kind of like Uniswap v1 was, just like a set of AMM pools, you actually have a much more modular design and architecture. And I think a big part of that for me is the introduction of this new customer, which is the institution. But let me kick it over to you. Like, when you kind of look at this new architecture that a bunch of DeFi protocols are trying, what is the driving force here? And then what are the implications of that for DeFi in general?
Yeah, well, I think like sort of the history of DeFi, it started as a bunch of protocols that were, for lack of a better term, like kind of one size fits all.
Yeah.
Like Uniswap v1, for instance, you pair everything with ETH, and everyone is just supplying to the same curve, the same X times Y equals K invariant curve. Um, Same with compound and lending. Like, you had one market, it had a certain set of assets that were approved, and each asset had a certain parameters for it. I think that was a necessary step for DeFi because liquidity was like so thin. There were so few users, so little amount of actual capital in these protocols, that if you were kind of having each person choose their own adventure with parameters or with like the type of pool they were using, you would never reach a critical mass where these protocols became just kind of minimally usable, having enough liquidity to really get anything done. So that makes sense how that was kind of the first iteration of DeFi. These big lending markets like Compound or earlier versions of Aave, where everyone was in the same market, kind of playing by one set of rules. Um, Now DeFi has actually reached a pretty decent scale of liquidity. There's tens of billions in some of these protocols. Um, and more than that, we used to have just kind of one client base, all just kind of early adopters, DeFi degens, who had a high risk tolerance. They didn't care about, compliance concerns, AML, anything like that. They were just happy to like kind of use the chain as it came. Um, and the concerns of the new crop of users, whether that's institutions, whether that's fintechs who are kind of using DeFi as a backend, They have a lot of, kind of more individual concerns and needs out of these protocols. Um, so taking the example of like a lending protocol, many users are happy to kind of sit in like a big sort of consolidated protocol that has a bunch of different assets listed and, same parameters across the whole protocol. But then, um, if you look at something like Coinbase, um, they had a very specific use case that they wanted for a lending protocol. They just wanted to have people be able to supply Bitcoin collateral and borrow USDC. They didn't want any of the other complexity or other sort of like risk factors that you'd have in a traditional DeFi lending market. So for them, kind of a more sort of individualized approach made a lot of sense. So yeah, they actually on Base they've um, launched this sort of DeFi mullet product where
Yeah.
users can use the Coinbase app and deposit into DeFi and do this Bitcoin collateralized loan position without any of the other sort of constraints or baggage that you might have with a traditional lending market. Um, so yeah, like the sort of fragmentation or the individualization of these protocols is actually a benefit for a lot of these new users. Um, that being said, it also presents challenges because um, you need like another layer to make the UX acceptable, like so that individuals, regular users don't need to be continually monitoring their positions, moving funds from X to Y, etc.
Yeah, and I just want to emphasize that. Well, I want to get into some of the challenges or the drawbacks to this model, but it seems pretty ubiquitous. And I think that the way that at least I think about that is that point about introducing new customer personas here. And I think that in the early days of DeFi Summer, if you look at the early iterations of something like Uniswap, or even if you were to look at something like Lido as an example, we didn't necessarily spell it out like this, but these were products that were built for retail for the most part. Like if you think about who was using Steth in the beginning, I mean, it was people that were trying to get, liquidity on whatever they'd staked into the beacon chain, right? And that was mostly retail at that point. You didn't have big macro hedge funds for the most part that were concerned with something like that. Although you do have whales, which are a little bit of an interesting mix in between. You might have started off as retail and then kind of gotten into the institutional bucket. But I think actually I want to pull up here as an example as well. This is an excerpt from Hasu's Goose 2. So this is the set of strategic objectives that Hasu writes for Lido. And I think he described it perfectly. So this we'll be hearing a little bit from Hasu during this season, but the way that he describes this as a shift to a product line for the staking ecosystem. And if you think about Steth originally as one product, it was mostly a retail focused product, but the challenge is if you have this new customer set, which is an institutional customer set, they'll have their own needs, which is namely they can't necessarily interact with a validator that they haven't KYC'd. And so if you want institutions using Steth, you need to allow for that. And that has informed this more modularized vault architecture, which you can think of, we'll get into it during the season, as a bring your own validator approach, which the original version of Lido with the staking module didn't necessarily support. And you're seeing that across a lot of different types of protocols in DeFi. And I think, at least to my mind, the driving force here is the introduction of the institutional customer really for the first time. And you can bucket, Coinbase as a fintech or maybe other, challenger banks or the Robinhoods of the world that may or may not, expand into crypto. Hopefully they will. But I would put it all as that one bucket, kind of the introduction of this new customer.
This episode is brought to you by Namada. Namada is the shielded asset hub rewarding you for protecting the multi-chain. Shield your data across any asset and any chain and get shielding rewards for helping strengthen data protection for everyone. To learn more, follow the link in the description below. Today's episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger is trusted by 7 million users, secures 20% of the world's digital assets, and remains the most secure hardware wallet for your crypto and logins. Follow the link in this episode's show notes to grab your Ledger today.
What are, in your mind, we're starting to get in, what are some of the drawbacks here? So maybe we can look at, as an example use case, something like Morpho versus Aave. I think one of the nice things about Aave, which has historically had maybe less of a modular design and architecture, is kind of have these nice network effects and liquidity network effects there. So talk to us, because the idea of this this what we're introducing here is fragmentation, right? Which has had, there are definitely drawbacks to that. So what are the challenges to this model?
Yeah, there's huge challenges. Morpho has generated a lot of excitement, but when you look at the size and the scale and how many users each of these lending protocols have, Aave has kind of a more consolidated model, and it's still way ahead in terms of usage, in terms of liquidity, because it's just so simple. Like you bring an asset that you want to use as collateral, you borrow one of the other assets in the market. You don't need to worry about the liquidity being set up in a pairwise way between those two assets. It's just, kind of all to all liquidity. Um, and I think that applies, not only to lending, but stuff like Uniswap, for instance. Um, in a way, it was simpler back in kind of the Uniswap V1 or V2 paradigm where everyone was supplying assets to the same curve, so to speak, that you supply into the pool and you don't need to think about um, what range you're choosing for liquidity or what pool fee tier that you're choosing. You just pick two assets that you want to provide liquidity for and you're set. So the complexity for users for these kind of more modular approaches to protocols is much more challenging, particularly for retail users who are managing everything themselves. Um, if I want to provide liquidity on Morpho, if I were to just provide it to these individual pools, whenever the demand changed from most people using Bitcoin to borrow to more people using stETH, for instance, I would have to like log on and then move my money over to whatever is paying most,
Right.
if I were supplying directly to the pools. Um, Same with Uniswap. If your liquidity is out of range, suddenly you have work to do as a retail user. Huge pain in the butt. Um, so it's really challenging for UX, for people who are supplying assets, liquidity providers, but also for users. What pool do I borrow from? How do I get my trade routed to the right pool that has the most liquidity? Um, it creates a need for all these additional abstraction layers at a higher level. Now, that being said, I think a lot of these protocols, they're aware of this and they are, actively building these solutions as part of the protocol where they have fragmentation at like a base layer, but then they're envisioning and building out these sort of higher layers of abstraction that help to kind of re-aggregate everything. Um, so I think that's the critical link is how do you kind of re-aggregate this fragmented liquidity when you make a modular protocol?
Yeah. And I want to just double underline that point on complexity. And yeah, this was a huge discussion when Uni V3 launched around being able to provide concentrated liquidity, right? And this just introduced far more complexity for the LPs. And this was exactly the question, right? Does this make sense for retail? And Uniswap didn't come out and necessarily say this at the time, but I think the answer now is pretty clear that, maybe this idea of retail being able to passively market make and generate fees is nice and everyone ideologically buys into that, but maybe the benefits of that aren't really worth the trade-offs, right? Which is a much degraded experience for users of the protocol. And I think there's kind of a gradual acceptance there that if you are, these DeFi protocols are going to require sophisticated financial actors to make good products most of the time. And when I'm curious, when you think about one of the other maybe things to think about is how risk and counterparty, like especially counterparty risk, changes in this environment and this idea of it kind of moving up the stack. So, when you think about these more modular designs, can you just talk a little bit about how like counterparty risk changes from your perspective?
Yeah. So I think Morpho is kind of a good example of this that's out now where um, people get very excited about it because the base layer of the Morpho protocol, the pools, they're completely permissionless. They're not upgradable. Anyone can make any pool for any asset pair of collateral and borrow asset. So it's kind of like really adhering to like the DeFi sort of principles, the goals that we have in DeFi, which is like a really governance minimized protocol. But that being said, the UX, if you just are, you know, Joe Schmo and you're supplying $1,000 to these various pools, if you have to move them each time that like there's a change in relative interest rates, that's a terrible UX. So the vast majority of people they're supplying into Morpho via vaults, which is basically like it's a risk managed sort of like risk curation asset management type of product where you have a vault manager, you're giving them access to your funds, and then that vault manager is deciding which pools kind of meet your risk criteria and that are safe to supply into, and then also optimizing between them to get the best, risk adjusted return. So you have the benefit where you're not exposed to governance risk at the base, the protocol layer, but then you do have a bit of sort of like governance counterparty risk at that next higher abstraction layer in the stack. It's challenging to think which is necessarily like better. There might not be like a firm answer of what's better or worse because when you're sitting across from a protocol like with a big decentralized DAO, like let's take a look at like Aave or Maker, you have all this risk of the governance that they have on the base layer of the protocol, but then the DAO itself is got fairly distributed governance power. It's reputable. They've been around for a long time. They're kind of Lindy. When you're looking at sort of like governance at the higher layer of the stack, you kind of have new entrants, people who have been around for maybe a year or less. They've got less of a track record, might just be run by a single company rather than like a distributed set of participants. So you're kind of, in a way, when you move the governance higher up the stack, you're kind of fragmenting the governance layer a little bit as well, which it's got challenges but then if one of these vault managers has a huge problem or rugs, everyone else in a different vault that's on that same underlying protocol is still safe. So it's a lot of trade-offs.
Also, in practice, isn't there a huge overlap in between the protocol teams and the dominant vault managers? Like I'm thinking of BA Labs, obviously, shout out, but also Stakehouse and Gauntlet, right? And between BA Labs and Stakehouse, that was a lot of the risk management that was happening at Maker in the early days and even up through the present was managed by those groups. Gauntlet, obviously, very famously, there's been a little bit of falling out them between them and Aave, right? But they were doing a lot of the risk management and curation for Aave in the early days. So it's almost like you took the parts of the DAO, you almost unbundled sort of parts of the risk management part of the DAO and moved it into these vault curators. And in practice, it's a lot of the same people, right, that are managing risk.
Yeah, no, it definitely is. I think it makes sense because the competency required for being a vault curator for a lending market is quite similar to the competency you need to be a consultant or like sort of like the service provider for a DAO style of management. So it does make sense, but yeah, it's kind of taking that same function and externalizing it out of the base protocol, but it's still, for the most part, it still has to exist somewhere else for the vast majority of users who are not qualified to be doing the risk management, or it's just too much work for them to be doing, and it makes more sense to like give that to somebody else.
Yeah. Well, I'm curious, and part of what this protocol design necessitates is this sort of cottage industry of risk curators in general. And I know we've talked a little bit offline. I know BA Labs does this. Maybe that'll be a good business. Maybe it'll be a little bit commoditized, but it is still interesting that now you have these, because historically, if you kind of think about the makeup of the early team of Aave, it's a lot of developers and engineers, right? Not super obvious, right, that you have a bunch of very, like kind of risk managers in that setup as well. I'm sure they ended up onboarding those people, but now it feels like you've got, groups that just do the risk management part and don't necessarily need to mess around as much with the dev stuff, which feels like a good separation from my perspective. One other thing that I'm very curious about with this design is how BD changes, and the more modular design architecture of something like Morpho to me feels like it's more of a BD driven model versus a retail marketing driven model. And I think the days in general of crypto Twitter being super important are getting less and less influential. And yeah, if you are a team like Morpho and you want to land a big account, right, like Coinbase, that can leapfrog you, billions of dollars worth of TVL. And so to me, it kind of changes the entire BD structure and setup of a lot of these protocols. And it kind of makes it a little bit more exciting because all of these protocols, everyone from even L1s and L2s to DeFi protocols are really one or two big apps or integrations away from potentially leapfrogging their competitors. So I think it makes the entire space much more dynamic. But anyway, this is a huge theme that we're going to be exploring for this season. And to introduce the kind of the second idea that I think it's worth poking at is this idea of vertical integration. And so maybe to lay the groundwork and historically how vertical integration has been thought of, especially in the Ethereum ecosystem, is I feel like it's a little bit of a no-no word, right? Where we had this philosophy that DAOs were supposed to be this flat structure where governance was minimized, and there was this strong preference towards maybe because of the decentralization ethos that we wanted these things flat and horizontal, right? And we could kind of have these nice DeFi Legos where Aave was the borrow lend protocol, and Maker was the stablecoin issuer, and these could just interact. And when you fast forward to today, there's been quite a bit of vertical integration kind of on two fronts, where Aave now has Go, Maker or Sky now has Spark, and we're kind of seeing each of these OG protocols offer competing lines of business. And so it's harder to even look at these and say this is why they're so different. But also, I think there's another area of vertical integration around, especially DEXs, where you started to see someone like Uniswap start at the protocol layer, but then move both up and down the stack. And I would also say for Jupiter, there's an analog here as well. But it's everything from getting the kind of the RFP off-chain layer of Uniswap X to the wallet layer. So they've got their front end and Uniswap. Now they actually have a chain and a DEX, like kind of the protocol and liquidity layer as well. And so they're just controlling more and more of how the user interacts with ultimately the brand. And I'm curious to get your perspective here. What do you make of this trend of vertical integration? Does it make sense, uniformly, or are there some protocols that it makes sense more or less for? And then, is the original Ethereum ethos here right? Like, does this fly in the face of decentralization or how we've historically thought of DeFi protocol governance at some level?
Yeah, no, it's been really interesting to see. I think people have kind of been anticipating that the kind of like kumbaya era of DeFi was going to be, basically on its way out at some point. And I think there's still a lot of protocols working together, but it is, sort of on the way out in a way. The money Lego idea was super interesting, and I think that's part of like why I got into DeFi is like just the idea that you can build on anyone else's protocol. But what I've seen is that it kind of was like an idealistic mindset where you're looking at all these protocols as just like super simple widgets, like basically like Uniswap V1 type thing, where there's no governance required, there's no like sort of active management or like soliciting users, growing your user base required. And for a lot of these types of protocols, that's just not really how they work in practice. They're protocols, but they're also businesses in a sense. So yeah, the idea that like you're going to be okay sort of funneling your users to some other protocol that is also a business that you have no control over is quite challenging. I think, there's a few drivers that I've seen for vertical integration, but I think like some of these leading protocols like Aave is a great example. They're kind of reaching a point of saturation for their existing PAM. Like they already own 65% of like the DeFi borrow lend market. So it's completely natural that they would want to expand into adjacent stuff like stablecoins. Makes perfect sense. There's a lot of synergy with lending markets. So yeah, I think there's people who have started to saturate their existing market. And then beyond that, like a lot of the value just in general in business is like kind of owning the user and having like a solid user experience from front to back. And if you look at something like Uniswap, where they are trying to like kind of own the entire like transaction flow, they can ensure if they do that, they can ensure that the user is having a coherent journey all the way through. And I think that, that adds a lot of value, and it kind of has a potential where they can have like a stickier, kind of deeper relationship with their users.
Yeah, I completely agree. I think there are two, maybe to try to summarize some of what you said there. there are two different reasons to do, or a couple of different reasons to do this. One is a UX thing, and then one is an economics thing. And I think in the early days, especially, I've heard Hayden talk about this from Uniswap, describing that, if you're a product-driven company, right, you want to make sure you've got high user retention, that your users are having a great experience. And said something like 80% of the complaints around people interacting with Uniswap didn't actually have anything to do with Uniswap. It had to do with MetaMask, right? So if you want to give your customers a great experience, no shade to MetaMask, but right, that was his perspective. So moving up the stack and controlling more of how your users actually interact with Uniswap, the underlying protocol, is you have the ability to give your customers a better experience. Then there's also like, especially in the Uniswap world, I know that team was really, really focused on eliminating MEV leakage, right? So something else that presents not a great user experience, but also kind of leaks value away from Uniswap is leaking MEV to the L1. And that can be anything from 12-second block time. So you have stuff like loss versus rebalancing lever on your AMM pools is definitely very real. Even just the cost of gas, back when the cost of gas on ETH1 was high, right? There was a real actual challenge for Uniswap. And if you think about, first of all, that presents just not great UX in general of your fees, your customers having to wait X amount of time or getting priced worse. But also, if you think about the fee, let's say users are willing to pay $100 for a swap fee, which they're not, but at one point they were comfortable paying that. If $95 of that is going towards gas, then there's so much less of the pie for Uniswap to grab. And so it makes a lot of sense for them to want to eliminate those gas fees that they're paying to the L1. So that's kind of everything at the settlement layer they're kind of moving down the stack and up the stack at the same time. But I think that moving up the stack today is probably seen as being slightly more valuable here. And I think that people are starting to rediscover some of the work that like Ben, kind of classical business wisdom, and guys like Ben Thompson at Stratechery have detailed with his idea of aggregation theory. But just having that relationship with the user is incredibly, incredibly valuable. And yeah, I think you're starting to see more DeFi protocols try to move up the stack and actually own that relationship.
Yeah, no, I think it dovetails a bit with kind of the like modular approach to building a protocol too. Like if you're relying on somebody else below you in the stack, basically you're depending on them to not screw something up.
Right.
And there's been plenty of cases in the past, 5 years where something almost went wrong with one protocol, another, like Maker, like Compound, whatever the case is, and everyone above them was, basically just hoping that they weren't screwed. So yeah, I think it's for economics, but it's also like a matter of like risk mitigation and kind of just like trying to ensure that you survive.
Completely. So yeah, it's going to be very interesting to see how all that ends up balancing out. I think the DEX space is probably where you see this the most. But one other area that I would highlight as well is companies trying to figure out where their core competencies are and then leveraging that across other business lines. And one thing actually that shout out to Adrian from Steakhouse, who originally pointed this out to me, is that running a stablecoin is not wildly dissimilar from the core competency required for running a liquid staking derivative or a liquid staking token. It's basically the same thing if you look at it from a balance sheet standpoint. So, if you look at over in Solana land, what Jito is doing, I think is fascinating, where you have these complementary lines of business that leverage the same kind of internal core competency, but you use it to benefit your other products, right? Like real synergies. So for Jito, they started off with MEV, where they obviously had direct relationships with validators, but they had a good understanding of how to extract value from transaction ordering. Then they parlayed that into an LST, right? Where obviously if you could redirect something like Jito tips into the LST yield, or even just allow, by extracting MEV more efficiently, you have higher yields. That's quite good for, your LST and that dominance there. And then a restaking protocol to decentralize some of that infrastructure. It all just kind of fits together very nicely. And you see that more in maybe other protocols than Ethereum necessarily. But that kind of leads into this next subject that I think we want to explore, which is DeFi outside of Ethereum. And one thing that I would be curious before we get into some of the differences about Ethereum-based DeFi versus DeFi that you see on other protocols is, you still, for all of the flack that Ethereum gets today, you still see that DeFi is extremely dominant on Ethereum versus other protocols. So I've even been pretty surprised in Solana land, right? It should be a massive boon to DeFi that you have lower transaction fees, but you still just haven't seen nearly the same amount of adoption on Solana versus something like ETH. And even, you know, the BlackRocks of the world and the banks, like they're kind of launching on L2s, right? And they're really leaning into the Ethereum, into the Ethereum space. So I guess just a question to you to begin, why do you think DeFi has continued to be as dominant as it has been on Ethereum? And has it surprised you to see it not take off quite as strongly on other chains, especially Solana?
Yeah, I mean, I think it has been a little bit surprising to me. As far as like what are the key drivers of DeFi still being so dominant on Ethereum and not so much on these newer, like sort of faster, more high throughput chains. Um, Ethereum has been lagging on a lot of key, fronts like speed, throughput, transaction costs. But I think in a way, like the most important thing for a lot of DeFi protocols is just like uptime and reliability and lendiness. For something like a stablecoin or a lending market, if you have downtime, that can sink you completely. Like, if the price crashes in an hour or something when the market is down and you can't liquidate someone, you're cooked. Solana's had no downtime recently, so they're actually, I think things are looking up for them quite a bit. Their reliability has gotten much, much better. Um, but it's still within, recent memory that they had downtime for, periods of hours up to like even a day.
Mm.
And luckily, the prices of assets didn't shift too much during those times, so it ended up being fine. But um, I think ETH L1 is still kind of the Lindy chain, like it doesn't go down. So a lot of the key parts of the DeFi stack, something like Aave, which has huge TVL, Sky, these other like core lending markets, that's what they value most. So, and also that's what the users value most. The users who are bringing big money to these protocols, they know that their money is safest when it's on the lindiest infrastructure. So I think that's part of it. There's also some quirks like the way that ETH staking it's like friendly for home stakers in a way because like um, you can basically stake with like a toaster basically or like a Raspberry Pi, what have you. Um,
In the
but
Gobi
they don't
Desert.
have delegation. So if you're like me and you don't want to run staking infrastructure, your only option is to use a liquid staking service basically. And um, that's a huge tailwind for DeFi. It's driven like a ton of TVL to all the lending markets. There's this whole like ETH liquid staked looping trade, which has been driving like just a ton of TVL and revenue to all these DAOs and DeFi protocols. And that was just kind of like forced on Ethereum because there's no delegation feature in protocol. But it ended up being a huge, huge boon to DeFi where Solana, like it's just too easy to do like delegated stake, and then the epochs are like 2-3 days. So the liquidity benefit of an LST isn't really even that significant.
Mm.
So I think even today, like what's the liquid staking penetration rate on Solana? Like 10%, something
Yeah,
like
it's
that,
much
15.
lower than Ethereum. Yeah.
Quite small. And I think that's definitely been a headwind for them, I think.
Yeah. I think also one of the things that Ethereum, again, still has going for it is just the amount of liquidity and users that it has versus other chains, even something like Solana, right? So I think, again, if one of the themes of this season is the introduction of the institutional customer, I do think Ethereum is getting knocked at the current moment for its rollup centric roadmap. And maybe it didn't get the path dependence thing 100% right. But I do think that these institutions are going to want their own environments. They're going to want their own L2 like things, right? So I think Solana maybe not prioritizing in its roadmap at all the ability to do that. There are drawbacks to that. There are definite boons to it, right? You have less fragmentation 100%, but there are drawbacks to that. And I do think this is one of those instances. I'm not sure Ethereum really thought like this. I think this is kind of one of those things where they might have gotten a little bit lucky here. But one thing that I think it's important to get the words right. I think the uptime part of what you described is super important for attracting institutions. I also, frankly, just think the amount of time that Ethereum has been around versus Solana is really important. Like that track record and consistency element is really important. But also it has way more users and liquidity even than Solana. And then there's a massive Pareto kind of fall off after that. So the reason I think it's important to say, I'm not actually 100% sure that the institutions care about what we all hope they would care about, which is the, the credible neutrality and being the most decentralized, and, you can run a Raspberry Pi. I really don't think they care very much about that, but I do think that they like the idea that it's been around for a long time. The uptime record has been really good. There's a strong track record, and it's got users and liquidity, and they view it as a new business line, right? An opportunity. So I think that's something that Ethereum has done super well. So I was going for it.
Yeah, I think there's like an interesting aspect too, where taking Solana as an example, but I think other kind of new high throughput chains, they have this benefit too, where because their sort of network fees are much lower and they have a lot more throughput, there's like more sort of monetary velocity within these DeFi protocols. They can get more done, like more transaction volume with less TVL, which is in a way super exciting. Like it's more capital efficient. Generally, there's just, they can do more with less, which is great. But then from the perspective of an institution, at least for these kind of like early joiners, like someone like BlackRock and Securitize doing BUIDL, their incentive to come join DeFi, I think they're trying to get their foot in the door early, and they're trying to be known as, innovators in the space. But the short-term incentive is just that there's a bunch of idle capital that they can sell into on Ethereum. And that's partly because the capital efficiency and like sort of the velocity of money on Ethereum and DeFi is much lower, but then it's giving them more of an incentive, at least in the short term, to participate. Because, I think BUIDL has already got a couple billion in TVL on Ethereum because there was all these stablecoins sitting around doing nothing. And it's like sitting ducks for them. It's, it's like free money. So it's weird. Like Ethereum is kind of benefiting from the capital inefficiency. It's like such an opportunity for these institutions to come in and sort of peddle their wares.
One other question that I have as well is how sticky is some of this path dependent stuff going to be? So, you mentioned like the penetration of liquid staking in Ethereum versus Solana. One big change there is just, you don't have delegated proof of stake in Ethereum. You also had the merge, which Solana was a proof of stake chain from day one. Ethereum used to be proof of work. Then there was this long transition. There was beacon chain, multiple chains running in conjunction. And if you staked, you didn't really know how long you would have before you could unstake. And so that was a huge boon to the rise of Lido. And, as you mentioned, this idea of looping. And so I'm curious how long some of these path dependency effects are they permanent or maybe slightly less permanent? And then also, what does the change in fees, especially on like main chain, mean for market structure? And one example that I would give you is, there were very early in Ethereum's in the Ethereum days, there were kind of these ideas of like 1-inch aggregators, right? And the idea is, hey, I've seen this play or this movie before. There's going to be the kind of liquidity and protocol layer that Uniswap has, but there'll be an aggregator on top of that, and that didn't really work. Whereas it has worked in Solana. And I think the idea is just that if fees in Ethereum are so high that, no one's going to pay, $40 for an extra hop if 90% of the liquidity exists in Uniswap anyway, right? So I'm interested to see how, different transaction fees on different chains lead to different market structures as well.
Yeah, no, I completely agree. I think Ethereum's in a bit of a weird time right now because gas is just so depressed. It's like one way to do anything. So even complex DeFi transactions on L1 right now are like $1, $2, which is great if you're using it. But I think, I don't really anticipate it'll stay that way in the long run. Even with a lot of L1 scaling on Ethereum and users kind of using L2s more often. It feels like Ethereum is always going to be considerably more expensive than something like Solana or another new high throughput chain. So like something like Phoenix, on-chain order book, I don't think will ever work on Ethereum L1. Instead, you have all these sort of interesting workarounds like a lot of like interesting intent-based architecture where more of the logic is happening off chain and you just kind of have settlements like the matching happening on chain. But um, on Solana, like there's a lot less resource constraints. So um, stuff like, on-chain perps, like Drift or something. Um, a lot of these DeFi protocols, which they're not really DeFi, but I think there's a future where they'll kind of be able to finance some of these DeFi activities on chain.
Mm.
Um, I think that's, at least for now, that's kind of like that's Solana's market. I don't think Ethereum L1 is really going to be able to compete there. So um, it feels like Ethereum is still kind of leading in innovation in DeFi in a lot of respects, but there's certain niches that I think other chains are going to be like out competing on Ethereum for quite some time.
Namada is the shielded asset hub rewarding you to protect the multi-chain. Built to give you full control over sharing your personal information, Namada brings data protection to existing assets, applications, and networks. Namada ends the era of transparency by default, enabling shielded transfers and shielded cross-chain actions to protect your data even when interacting with transparent chains. Namada also introduces a novel shielding rewards system. By holding your assets in the shielded set, you help strengthen Namada's data protection guarantees and collect NAM rewards in return. To learn more about Namada, follow the link in the description below. Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional password management. Follow the link in today's show notes to get started with Ledger today.
Actually, I want to return to that point that you were making about BUIDL and BlackRock and introduce this next big theme as well, which is, this is going to be no surprise here, but I think it's got to take up a good amount of airtime during the season, which is real world assets and especially stablecoins. And this is something that people have been talking about for a long time. The stablecoin market cap chart is one of the few charts in crypto which is up only, which is part of the reason I think people like to talk about it. But part of the reason it's exciting outside of just the fact that empirically there's quite a bit of demand for it is you can start to see it slot into the macro picture of something like the United States, right? So a bit of context that we haven't necessarily talked about is, you have the largest, capital market in the world opening up and saying, we want to be the crypto capital of the world. And you also have the Treasury Secretary, Scott Bessent, describing stablecoins as a key pillar of how he plans on managing the United States debt, which is unbelievable, right? That's kind of wildest dream stuff if you just rewind the clock back 3 years ago to where we were in 2022. And so I think there's a lot of macro tailwinds for the adoption of things like stablecoins, but also real world assets more broadly in the form of something like treasuries, and more recently around private credit. And so one thing that I'm curious to get your take on here is, how do you see the adoption of stablecoins going? And I'd love to, we'll bring on some experts this season, but I would love to pick that apart. And I'm also curious, if we see the US adopt stablecoins to the degree that they say they're going to, I assume there's going to be a wave of new issuers. And I'm curious how you see the market share of the incumbents playing out. Is Tether going to maintain its 60% market share that it currently has? Do you see that bleeding out? And how do you see all that changing with the introduction of a bunch of new stablecoins moving on chain?
Yeah, no, it's a super exciting time because for once like the government is supportive of stablecoins and RWA and just kind of this general path of development. People have been sort of anticipating that yield-bearing stablecoins are the next big thing. They've been sort of saying this for quite some time, and it hasn't panned out yet. It's still basically a duopoly between Tether and Circle, USDT, USDC, and it's tough to say what will happen there. But I'm guessing that Tether is going to maintain a lot more of its market share because its user base is concentrated mainly in emerging markets, overseas, and the difference between 0% yield on US dollars and 4% yield, from like sort of a yield bearing stablecoin that's a proxy for treasury bills, um, is a big deal for maybe like a domestic US user. But for someone whose, national currency is going down 20% a year because of inflation, it's not as big of a deal. And they just want, broad acceptance, trust. I think they like the idea that Tether is kind of an offshore operator, so it's a
Yeah.
little bit less under the US's thumb. So I could be wrong here, but I actually see Tether maintaining like a good deal of their existing market cap and market share. And I think for the onshore sort of space, I actually see USDC having a lot more competition because a lot more of their business is probably going to be from fintechs who, basically they need the economics of the sort of like the float, the T-bill yield to run their business. It'll be a lot of onshore users who like, I'm not going to hold a lot of USDC on chain because I can just take it and put it in Treasury Direct and earn,
Yeah.
some yield. Um, so really interesting time, but I think that the onshore stablecoin market is going to be a lot more competitive, and you're already seeing. I think that Paxos has this USDG stablecoin that's like signing up a bunch of consortium members. A lot of different activity like that, where big big institutions in payments and fintech and traditional finance are getting in the game, and I think USDC is probably going to be their first target to like vampire attack.
Yeah. I think the division of rest of world and maybe you can view Tether as eating the euro dollar market, which this isn't a macro podcast, but it's kind of this market for offshore dollars, which is actually much more opaque, actually larger than the market for onshore dollars, domestic dollars, and largely unregulated. So I think that's very interesting for Tether. The other thing too, I think that both USDC and USDT have in common is that they innovated on distribution. And Tether, this is probably something that you can't replicate, but the need at the time was you had all of these offshore exchanges. People wanted to trade in dollar pairs, but they couldn't actually hold dollars. So they wound up with Tether. And Tether was able to become a key trading pair across assets like BTC and ETH. So that's a really difficult thing to replicate and a persistent source of demand. Over in more US regulated land, you have the center consortium in between Coinbase and Circle, where the distribution engine for USDC was Coinbase for the most part, and USDC is still the dominant trading pair for stablecoins and DeFi. The challenge for USDC is now Coinbase understands its leverage, and from my understanding, has basically eaten up the entire rev share that Circle had there. So I agree. I think there's going to be some pressure under USDC here, and I also think that probably new issuers will also need to find a way to innovate on demand. And I could see that coming from historically what it's looked like in crypto, like an exchange like Robinhood or something like that, or a player who's dominant in payments and they can just replace a lot of their existing payment flows with stablecoin rails. That I actually see that as being really powerful in the end game, but it's so disruptive to their business model, right? Like they'd have to eat into a lot of their own fees and kind of cannibalize their existing business, which is maybe why you haven't seen PayPal be as successful in the stablecoin game as everyone predicted. Right? If I were the CEO of PayPal, I'd be like, yeah, what am I going to do? Eat 98% of my own revenue here? That would be not great for my shareholders. So I don't know. I agree. I think Tether's in a really good spot here for the most part.
Yeah, I think PayPal is an interesting test case too, because you could see in the future it'll be kind of a more core part of their payments business, but so far it's kind of just been them like dipping their toes into DeFi, trying to get listed on various lending protocols. They have some incentives, being paid out in various places, and um, it's actually quite difficult to break into DeFi protocols with some of these new stable coins or other products if you're not like differentiated. And I would say, PYUSD versus USDC, they're both redeemable
Yeah.
sort of onshore stables. So if you're a user, Why are you going to use PYUSD when there's already a lot of liquidity pairs, indexes, and there's already a huge liquidity pool in Aave. It's part of like sort of the Sky PSM. There's all these integrations, so like it's a much tougher sell to like be the first one to say, oh, I'm going to use this different stablecoin, even though it's basically offering the same exact value prop. And it's difficult to see what is going to help tip that for like the big DeFi use cases. Um, but what I think could have a little more success is when you have a net new product, like something that is actually differentiated. Um, I think some of these T-bill products, like Biddle, they're paying out yield, and it's also just purely like a T-bill fund,
Yeah.
which in some respects has a bit less risk than stable coins. That's seen a lot of traction. And as we get kind of more esoteric, like credit products, like you were mentioning, private credit on chain, it'll be able to deliver, higher yield than T-bills, a different sort of risk return profile. Um, I'm not sure if that's going to like see immediate traction in DeFi degen land, but for some of these protocols with a lot of excess capital, Sky and all the sub DAOs over there, some other lending markets and such, like I think it could be of major interest.
What do you think the value proposition is for private credit issuing on crypto rails? I've asked. So Apollo just launched I forget the name of their fund, but it's it's their distressed credit fund. And I looked recently, it's got something like 5 million in TVL or something. And I'm just curious, what is the rationale here? And oftentimes when this, I have no insider information here at all, but generally when you see stuff that doesn't make sense, they're being incentivized to do that. So someone from the Solana Foundation or Kraken, correct me here if I'm wrong, but I think that they launched on this on Solana and also on Inc, the Kraken L2. So sometimes these things are incentivized, but yeah, I'm curious because Apollo, I'm sure has no difficulty with distribution whatsoever of their private credit vehicles, right? So I'm just curious what the benefit here is here on the issuer side.
Yeah, well, with distressed debt, I mean I'm just laughing because like crypto has like our fair share of distressed debt without any extra
We
help.
don't need any
Like
help.
every few years, yeah, every few years we have a bunch of people go bankrupt and yada yada. So it's funny from that perspective, but yeah, it's tough. I mean, I would say in a way it's probably their way of just dipping their toes in. Like they're figuring out how it works. They're figuring out what's kind of like the transaction pipeline and all the steps to make a tokenized product. Um, I think you know, more than likely the products that succeed, they're going to go from simpler to more complicated gradually and kind of in a stepwise fashion. So like the first real successful RWA products are tokenized T-bills because they're basically almost like a stable coin with yield. They have like very minimal duration risk. They have no credit risk. Um, any idiot can like look at them and know like what they're getting versus something like distressed debt. It's quite complicated. You kind of need to be a specialist to know whether you're investing into something that's actually like a good bet or whether it's just somebody shoving all of kind of like the dog turds into a product and selling it to you. Um, so yeah, I think I would envision that Apollo product is probably more of them testing, but um, I could definitely see, maybe you don't go directly into the deep end of the pool of private credit, but you go from T-bills to like corporate bond ETFs, and then you go to high yield
Yeah.
corporate bond ETFs, which are still like public market assets. Um, and then once you kind of have a developed market for those sort of things, and protocols are a little more familiar with how to use them or on-chain users, then you can start getting into more challenging like private assets. The flip side of that though is that um, private assets, in a way, they actually benefit a lot more from being on chain because their liquidity situation is quite poor now versus public debt is tradable. It's in ETFs. Um, so I see why people want private credit to work on chain because uh, it's like such a step change in the liquidity and the user experience for people who are holding and trading this stuff. The flip side of public credit being maybe more suitable for DeFi and on-chain investors and protocols is that private credit benefits more from tokenization because it's got a lot of friction for trading and for transferring. So it makes sense that people are more excited from like the TradFi space in private credit on chain because tokenization would be such a a level up for that asset class.
Yeah, that really resonates. And it does feel like there's the opportunity for a barbell here where you have the most liquid, types of real world like US dollars and treasuries and that type of thing, which there's just an enormous amount of demand for that type of collateral on chain. But then also it makes sense for the most illiquid private assets. And there's actually one of the maybe the more cynical approach to this would be, I'm sure there are articles that you can see in the Wall Street Journal at this particular moment in time where PE funds are basically lobbying to be able to include private assets in 401ks, and that's called stuffing, right? They've lost their they're looking for more buyers for their assets to keep valuations where they currently are, and so there is an incentive, right, for more illiquid forms of, but also it's just on a more kind of first principles basis. Yeah, the friction around issuance of especially private assets like LP shares or real estate or whatever it is much higher. So it makes sense for that to be on chain writ large. So
One other aspect is like sort of the people who are on chain now, they kind of have like a degenerate, like super high risk tolerance. So in a way, like maybe it's a good fit to like have distressed debt because I think people in DeFi they don't get out of bed for like a 5% yield. It doesn't really excite anyone. But if you can have like a 12% yield on something that's very risky, we do that all the time. That's like our yield farming.
This episode is sponsored by Citrea. Citrea is the first zero-knowledge rollup to enhance the capabilities of Bitcoin blockspace, enabling Bitcoin applications and unlocking Bitcoin's full potential as a programmable financial platform. With Citrea, developers can now tap into Bitcoin's liquidity to build scalable payment systems, privacy solutions, and more. Citrea is currently in its testnet phase and is approaching its mainnet launch. To learn more about Citrea, follow the link in today's show notes.
okay, maybe that introduces kind of this final idea that we want to unpack this season, which is this idea of financialization and the professionalization of historically retail-focused activities like yield farming. And I'm kind of combining a couple of different ideas into one theme here. But I'm curious because the idea of securitization and the increasing financialization of the economy writ large, it feels like a big mega trend in finance over the course of especially the last 20 years. This was particularly salient during the 2008 housing bubble, right? And Great Recession that followed, and people were very confused, and no one really understood this idea of collateralized debt obligations and CDS and all of this stuff. But yeah, it feels like that trend has the potential to be supercharged even in crypto. And I'm sure folks who might be participating in the DeFi ecosystem today start to see parts of DeFi look more like that than less, I think. And so, I'm curious just what your thoughts are about the increasing financialization of crypto. And, in addition to that, I'm wondering about kind of like novel and interesting way of importing TradFi yields and bringing them on chain. So maybe we could talk a little bit about some of the energy related securities that we're talking about. We'll hopefully speak to one of the founders of a DePIN, very interesting DePIN project over the course of this season. And then finally, I also think that what the folks at Turtle Club are doing around professionalizing TVL and kind of bundling and acting as a syndicate for investor interest by moving TVL into different DeFi protocols and professionalizing some of the negotiations and the yield that's happening there is also a really interesting trend. So would love to just get your take on some of the financialization that goes on in DeFi. Is crypto like a breeding ground for even more financialization? Does it make it easier to do? Is it better? The pros and cons? How do you see all of that? And then we can get on to the Turtle Club and TVL stuff.
Yeah. I think crypto is like sort of the killer use case of crypto is tokenization, which is naturally it's financializing a lot of new things. So it's I think crypto has like a lot of strength in in sort of the like product structuring, if you want to securitize something and kind of split it into components, that's something that crypto is actually very good at. Smart contracts are like a supernatural fit for that, and I think they can do it more efficiently, more reliably than just giving a bunch of assets to an investment bank and having them chop it up and sell
Yeah.
it. Um, so just from a functional level, I think there's a lot of kind of meat on the bone there for crypto to take. Um, it's also reaching, that point of maturity, kind of like how protocols are becoming more modular because they have different user segments that have different needs and wants. Um, I think that's kind of like the main driver behind a lot of like the securitization and tranching that you see in TradFi. Like some people want only AAA rated, like super safe assets. Um, and then a lot of other people are happy to take, a lower rating, a bit more risk to get a higher yield. Um, and you can take, a bunch of home loans, like a mortgage-backed security. Naturally, like the sort of whole pool of home loans is not going to be as safe as some of these users want, and it's not going to be as high yield as others want. So you can
Mm.
just structure it to give people what they want and serve more diverse user groups. And DeFi, we're having kind of greater diversity of user profiles. So um, it's a big opportunity for us to start digging into structuring, stuff like I think Pendle is like, kind of a simple example of this where some people just want a fixed yield. Some people want to be a degenerate gambler and bet that the points are going to be worth a lot. And that's become a huge market in DeFi. So yeah, I think there's a lot of tailwinds to tokenization, and just generally kind of like structuring stuff on chain.
Yeah, I agree with that as well. And I think, I've sensed a little bit of an allergic reaction to some of this in crypto. And I think that's because the ethos of crypto largely is born out of Bitcoin, right? And Bitcoin was a counter reaction to some of the shortfalls of the existing financial system, where there are bailouts, but also, people saw too much risk in the way that the existing financial system was constructed. And when we kind of dug into why did 2008 happen, which was obviously led to the genesis block of Bitcoin, people were upset at the amount of risk that bankers were allowed to take, and those losses ended up getting socialized. And Bitcoin is like the antithesis of that, right? It is very robust and solid and anti-fragile. The trade-off of that is that it's highly inefficient, right? And a lot of the early designs of DeFi, and even still to this day, you have mostly over-collateralized lending, which is not capital efficient at all. And they're huge. There's always a little bit of a trade back. I think this is one of those laws of physics that you can't fully get around, which is there's a trade-off in between robustness and efficiency. And so I think we're going to start to see the pendulum swing in DeFi more towards efficiency than robustness over the course of the next decade or so. And my hope would be that the better tech of building on blockchain rails will increase transparency and help remove some of that risk. But I would guess that we see more, tranching and financialization than less, for sure.
A lot more financialization, probably a good dose of moral hazard, and people, taking risks that they shouldn't be. But that being said, yeah, I completely agree. I think the fundamentals are very strong. Like you can have atomic settlement, which reduces a lot of like settlement risks that you have when everything has to be, settled through some third party investment bank or something like this.
Yeah.
You have more transparency. Um, so I think, it's maybe even part of why the regulatory picture is improving for crypto and DeFi is because there's actually a really strong story to be told here of why DeFi infrastructure is really suitable for prime time, and it can actually make the financial system safer.
Yeah, one thing I've wondered, and maybe it goes beyond the remit for this season, but moral hazard comes from the backstop of the taxpayer, right? That's what it is. It's privatizing gains and socializing losses. And in crypto, you don't really have the ability to do that. And that leads to some very poor UX. People often say it doesn't make any sense for us to have 10 different stable coins. But in reality, what we mechanically have is about 50,000 different stablecoin issuers in the United States. Every single bank is its own stablecoin issuer, right? Like dollars aren't technically fungible bank to bank. However, you have such a strong guarantee between the FDIC and the Fed that it's actually fine. Everyone just accept, okay, you can call JPM USD the same as BOA USD. And because we all know that it's backed up, that'll be fine. But you don't really have that option in crypto. So I'm just curious how far you can really, it's almost like trying to trade off some of like a gain in transparency and tech for this kind of social backstop that we've all engineered around the financial system. And I'm curious how much the technology improvement can mirror some of the benefits of the social contract that we have in society. Open question.
Yeah, I think well, it's like uncomfortable to admit this, but I feel, as somebody who works in risk a lot, like I do feel there's aspects of kind of moral hazard that come into DeFi in a way. Like, back in 07, 08, like if it was rated AAA, even if it was like the top tranche of a subprime mortgage-backed security, if it has a AAA rating, you just treat it as if it's risk-free.
Yeah.
In DeFi, I think we have some of these sort of like sacred cow type things like Lido. Like we know Lido is not going to get hacked. If it did get hacked, it would kind of like basically put us back to the Stone Age. So there's,
Mhm.
in a way, it's like everyone feels okay taking a lot of risk exposure to Lido. It's very reliable. It's a super Lindy protocol, so they've earned it in a way. But I think in the back of people's minds, they're also thinking, well, everyone else is taking this risk. So like, there's no career risk for doing this. Like maybe it gets bailed out. There's similar stuff with like USDC or Tether. Like, who's gonna get fired for having exposure to USDC?
Or L2s. People Vitalik wrote that famous post, don't overload Ethereum's consensus. And I think everyone at the time thought, okay, I get what you're saying, but let's be real. If there was some catastrophic hack on optimism and, 100,000 ETH were lost, yeah, that would be tough to not roll that back, right? When you're trying to push everyone to L2. Maybe less so today, actually. Now that Ethereum L1 might feel a little bit more competitive with L2s, that's a really interesting concept, actually. That would be an interesting debate to revisit because at the time, I think everyone just assumed, of course, Ethereum would roll back. But now, maybe less obvious, actually.
Yeah, I guess that's part of, I'm not like an expert in this, but I think that's like part of the whole like native rollup push, I guess. It's
Yeah.
like if the rollups, if it's part of the protocol, then if there's a bug, of course, if there's a bug in L1 Ethereum, of course, you fix it because it's inside the protocol.
Yeah.
So yeah, I mean the idea of like enshrinement for like some of these risks. I mean, there was discussion of like sort of nationalizing Lido. I don't think it really got anywhere a few years ago, but like the idea of enshrining an LST, I think moral hazard, like it crops up everywhere in finance, and I think DeFi space has actually done very well so far, but it's something that we'll have to grapple with.
Oh, one thing that we forgot to discuss, by the way, in the area of vertical integration, you just reminded me of it, is we'll try to zoom through a couple of these last ideas because I know we're running low on time here. But one other thing that I think is really interesting and worth exploring is kind of this idea of, people you did used to talk about enshrining Lido. Well, recently you've had L1 ecosystems like Barachain launched with essentially native apps, right? Like Honey and like enshrined borrow lending apps, right? And so where does that line? And that reminds me of first-party apps, like when Apple launched its iPhone, right? There weren't enough third-party apps at that point yet, so it had to make its own first-party apps. So yeah, that's kind of an interesting idea to explore, I think, throughout the course of the season. And one other question that I have for you that I would love to get at is actually I was listening to a podcast today with Joe Weisenthal, who's quite a good, I think, representation of the zeitgeist of how the average sort of finance and relatively intelligent and forward person might think about crypto. And he actually asked this question, hey, if I really believe in stablecoins are mostly on Ethereum, why is that not translated into Ethereum price appreciation, ETH price appreciation? And that is something that I would like to get at this season as well, is what does the adoption of RWAs, stablecoins, how does that impact the native ecosystem, but also the price of the L1 token? Because on one hand, I think intuitively, and this is where I think I am going into the season, more stablecoins should equal good for the ecosystem, right? Like that just feels intuitively like, okay, if a bunch of stables end up settling down here, that should be valuable. On the other hand, I could also see, this is how we've talked about ETH historically in the past, that it's got this form of money and you denominate NFTs in it. And it was the major pair, right, for, pair trades. But now, actually, stablecoins are kind of competing with that, right? And actually, you could just hold stablecoins on Ethereum and you don't need to hold ETH anymore. And most people hold dollars. They don't hold ETH in the world. So what do you think going into this season? How does the impact of stablecoins and RWAs, within an ecosystem impact the price of the L1 token?
Yeah, I have heavy ETH bags, so I want to believe more stables, more RWAs are good. I think, you can look at a L1 token kind of like a government, and like if there's more economic activity inside of like the national economic zone,
Yeah.
eventually that'll flow through to the government sort of having more value accrual, I guess. I don't know how you'd say it. So I still think it's good, but yeah, it's going to be a bit of a challenge to like see once you have L2s with like gas abstraction, like you can pay gas in USDC. What is going to be the reason to hold ETH? Is it just going to be, DCF? Is it just going to be based on fees? Or is it still going to retain some of this moneyness aspect? So yeah, I think it's a big open question, and as particularly as you get more RWA backed stable coins and like it's less of the classic like over collateralized ETH borrowing. It'll be a bit of a headwind, I think, for ETH to have value accrual, because it's losing a bit of this traditional like everyone needs to hold it for gas, everyone needs to hold it as like a trading pair currency. So what's going to fill that place?
Yeah, I think that's the big question. For me, the way that I try to square this circle is that if investors look at the fees that are being generated from transferring stablecoins, or the marginal activity that a bunch of stablecoins create, if that flows back in the form of fees paid to ETH holders, then I think it will be good for ETH. I think if it just directly competes as a store of value for ETH, I think that will be bad for ETH. So I think that if I was unilaterally in charge of ETH, the protocol, I would be very focused on trying to figure out how I can translate the fee activity that gets generated from RWA type assets into going back to ETH holders. Because I think if you don't figure that out, that's not good.
Yeah, I mean, I would just put in like one little point is that there's a lot of people trying to make Bitcoin DeFi and Bitcoin L2s happen. Like, is this bearish for Bitcoin? If they suddenly have RWAs on Bitcoin competing with BTC, I would say probably not. It'd probably be very bullish, but it's an interesting question that they might be kind of encountering the same challenge.
Probably same answer for ETH, right? Short-term challenging and longer-term. I think the same exact answer for ETH, actually, is kind of how I view it. It does complicate the Bitcoin story. That's the beauty of Bitcoin, actually. It's that, man, it has such a simple story. And for me, I actually read this, one of the most influential business books I've ever read was Building a Story Brand. It's about 50 pages. Everyone should read it. And it has a lot of very salient examples of what it takes to build a brand. It has to be really simple. And this has always been my beef with ETH, is that if you can't describe it in one sentence, that is a problem. I know that some people push back, but that's not a problem. But Bitcoin is just digital gold, very simple. But okay, last thing is, and I'll just speed through this here and then we can conclude because I know we've already gone for a decent amount over time. But I think that, one of the persistent, something that crypto innovated on is this idea of yield farming, which is essentially distributing the native token to new customers to bootstrap demand and solve the cold start problem. And over time, that was very, pretty unsophisticated in the beginning, and now has gotten far more sophisticated. And you've actually got the introduction of protocols like Turtle Club, who act on behalf of investors. They're kind of a syndicate type model where they gather up a bunch of different pools of assets, and then they use collective bargaining power to bargain with protocols. Right? And the idea is on the investor side of things, okay, someone's going to negotiate with a bunch of more leverage because they have more assets behind them, so they can get a higher yield. And actually on the protocol side of things, they get something too, because you can lock in a certain duration or period of time. So it's kind of this form of, and over time as well, you should be able to get a better sense of what the true cost of capital for protocol is. So that's been completely unquantified up till this point. So there are benefits, I think, from both sides, and it'll be interesting to kind of get at the the professionalization of this new form of kind of capital raising slash. But it's interesting for users to know, because I'm not really sure, when people see TVL moving into a protocol, that they understand where that's coming from or how those user behaviors have changed over time. So that'll be.
Yeah, it's super interesting. I think like Barachain is another great example of this. They had this like Boyko thing, which was like a
Yeah.
pre-deposit scheme that's now put just billions of dollars of TVL into their ecosystem. It's like Barachain's extremely highly liquid. So I think it'll be really interesting to see how this works out for new protocols. It's a completely different playbook than, starting at a low FTV and just releasing your token and hoping that it kind of has like this flywheel to pump it up. So yeah, I'm pretty excited to see how these experiments are going to play out. Yeah, that being said, like some protocols are doing it just to kind of buy metrics. So it's challenging to like know, like, are you just optimizing for vanity metrics, or do you actually need this to help fix the cold start problem?
Yeah, and this is a debate that happens around especially different metrics, and the data providers especially love to get arguments on Twitter about stuff like this, because and people in TradFi argue about metrics all the time, right? And there are these sort of vicious fights about it. But okay, so you see $1 billion of TVL moving into a protocol. Does it matter how it got there? I think the answer is probably yes, right? Like I think it makes a difference whether that's purely organic TVL, or whether it's incentivized in some way. However, you could also make the argument, and people will, okay, organic has historically meant mercenary retail airdrop farmers. Is that actually better? I actually am not sure. I think you can make the argument, and it actually be worth it to pay a couple extra basis points if you can lock in some amount of duration. And is it really organic if this is just like, is it more organic for a Twitter user airdrop threador to be getting that reward and putting their capital in versus, family office in Dubai who Turtle Club is negotiating on their behalf? To me, like, that's where I think there's some amount of validity here, but people screaming that one is far better than the other, I think is probably off base. I don't actually agree for the most part. So, it's just interesting to understand the mechanism of how it happens, and then everyone individually can make their own value judgment about how impactful all of this stuff is. But I think just shining a light a little bit on how this stuff is working in practice today will be valuable for people. And yeah, we'll hopefully have the Turtle Club guys on here. I connected with them. They're super interesting. So anyway, man, I'm really looking forward to this season. I feel like DeFi is having a moment. We're about 8 years into this experiment, and it feels like a lot of the thorny problems that we were wrestling with in the beginning are, if not solved, on the cusp of being solved. And there's basically just no point in time I'd rather be doing this with, and no one that I'd rather be doing it with as well. So this will be a lot of fun. And yeah, guys, hope everyone is also as excited about this as we are. So
yeah, looking forward to it. Should be a great season.
Should be a blast. All right, guys, tune in next week for our first episode. Take care.